Welcome to the daily update, where I'll go over the action in the market from Monday, October 28th, and we'll see how things look for Tuesday, October 29th. Kind of a sleepy day. We didn't have any economic reports that came out, but we're getting ready for some major reports to be coming out as the week unfolds. We also have the election coming up in a week, and the Fed is going to be meeting right after that, and it looks like they're going to cut interest rates another 25 basis points. And you've got things going on in the Middle East over the weekend. There was an attack by Israel on Iran. There could be more after this. So there's a lot of things, but the market's holding up for right now. We're still positive. We're above the 20 period moving averages. We do have some internal measures that we look at that are showing weakness that really didn't improve on Monday. So we're seeing a bit of a mixed picture that way. But when you look at it based on moving averages, we're still looking positive. There's a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. Please feel free to check that out. There are links that'll take you to the website as well as to a video that talks more about that. If you have any questions, you can email me. One of the benefits is you get the videos as soon as they are available. Also, the daily video. That's the real foundation. We just finished the weekend. I did all the weekend videos, but the daily video is where we take the things that we see in all of the videos and put them together, and we can see them change day by day. I know there's a lot of charts. I know the videos are longer. If you want to get a really good grip from a technical analysis aspect of where we're at, the daily videos should be viewed at least as often as you're able to do that. All right, let's go back and talk about what happened. We had a gap higher open. The futures were positive. Europe was pretty positive for the most part. But after the open, we just kind of chopped sideways and we drifted lower there for a while, but there was really no conviction behind that. It was more of a lack of continued buying rather than any selling that we saw. Even with the drift lower, we were able to stay above the daily pivot at 58.24. Then we just kept chopping, kind of drifted, and we ended up closing at the daily pivot. We were up 0.27%. Volume is still below average. Not surprising in Monday's session, but this is pretty much what we've seen. There was a down day over a week ago where we saw above average volume. Other than that, volume continues to be below average. We are positive in the short, intermediate, and long term as measured by the moving averages. Really no change with inflation right now. We'll get some more readings on that and how the market is adjusting to that as the week unfolds. We did go up with the 10-year yield, but it didn't seem to have as much of an impact on stocks. And we have all the geopolitical things that are going on right now, plus the US election is coming up. Some comments. We're back under 20 now with the slight update. We had closed over 20 on Friday. We closed slightly under 20 in Monday's session. That's still a very high reading, but 20 is kind of the line in the sand between turning quite a bit more negative and at least having a chance to stay positive, but that can always change. We're keeping an eye on the Middle East. Oil actually fell even after the attack over the weekend. We dropped down to $67 for oil. We only have the Sean trend meter, and even that's not extreme positive right now. And we have, on an oversold basis, we showed a little bit of an improvement with the McClellan oscillator, but we're still looking extreme negative. In the intermediate term, we're still looking extreme positive, just barely with the bullish percent index, but it's declining now. But when you look at the 10-day new highs, new lows for the S&P, we're still getting a very high extreme positive reading, which is showing that more intermediate to longer term, we're still holding up there. Long term, we're still looking pretty extreme with the 150 and 200 simple moving averages, but they're also suggesting good long-term momentum. No change to the scenario yet. We'll be watching these economic reports to see if they come in stronger than expected, but it really hasn't. There was that one day a week and a half ago where we had a whole slew of economic reports that came out, and they were pretty much all stronger than expected, and the market was spooked over that. But since that time, the market settled back down, but we'll be watching to see if there's any change to this scenario. We were up with the dollar. Interest rates were up. We closed at 4.28% now with the 10-year yield, where after Friday we were at 4.23%. We're still inverted with the 10 to the 3-month yield curve. We're uninverted with the 10 to the 2. That hasn't changed. Sentiment is still positive. We actually ticked up. We got up to that 75 level and then started drifting down. Well, in Monday's session, we were able to get back up to 62, where we had been at 59. We are positive with our trend, but we're still below the moving average. So it suggests a trending environment that is weakening, but it's still positive with the green line on top. With the update, our bias is positive, and I've switched the momentum over to mixed because we're not really showing any strength, and we're potentially coming into one of the strongest times of the year seasonally. Doesn't mean it's going to work out that way. We don't use it to forecast. We just use it as a guide to give us kind of a model to work from. Okay, didn't have any economic reports in Monday's session. Here's Isabel Net, where if you take out tech from the S&P 500 earnings growth, it's pretty much gone. That's what you see with the yellow line here. And that's why folks are favoring tech. And that's why we pay attention to the tech stocks and the mega caps and the Magnificent Seven, because they really drive the indexes because they're also driving with their earnings going higher. Then we look at the cyclically adjusted PE. This is the CAPE. This is what Robert Schiller developed, and I go over this in the weekend video, the intermarket analysis video, and it's pretty high now relative to history. Okay, it's coming in at about 38 when you adjust it this way. We're getting a little bit lower reading. I actually go to his website to get that chart. But when you look at the 10-year annualized return, forward return, what's going to give here? Are we going to be able to go up with the light blue line, or are we going to come down with the dark blue line? Then looking at volatility premiums, they've really ramped up across the different asset classes. With that in bonds, especially in standout, we're just seeing that's the purple line here. And as bonds have been under pressure based on price lately, they're still in longer term uptrends, but we've been seeing interest rates going back up. And then you have the stocks. That's kind of measured here in a different way, kind of like what we look at with the VIX, the volatility of oil, and then foreign exchange volatility. But the standout right now is the volatility, according to this, in the premiums that we're seeing with the price of bonds. Then the investment grade credit spreads, I show this in the weekly video and then I bring it out in the daily video when it's needed. We're getting very low readings right now. That's why I haven't been showing this chart. This is suggesting that there's complacency, that there's not a lot of risk that's being figured into this particular chart. And we look at federal debt growth and gold. Okay, federal debt growth and gold price changes on a year-over-year basis, where we're seeing gold really moving up now. But if you still compare it to the S&P 500, they're both doing pretty well. I mean, the S&P is coming off of recent all-time highs, and so there hasn't necessarily been a real advantage in holding gold over the S&P 500 unless you're really into gold and you study that area and you've been waiting for something good to happen there. You're doing good. But if you were already in stocks, you probably, if you look at the ratios between the two, at least to this point, you probably have decided to stay in stocks. And then here's a measure of the debt, total debt outstanding, and then the federal debt that's held in public hands. That's bonds, basically, where we're seeing gold really going up here. And then the cumulative debt growth, that's what they project it to be. Trump without the tariffs, they expect it to kind of level off and then go down. And then they're pretty much figuring that the market anyway is figuring that Trump is going to win, but anything can still happen. So they see it kind of going up here and then eventually trailing off, where kind of see a similar thing here if Harris ends up winning. And then these are bond fund flows by different categories, where we're seeing money coming out in some areas. You take all bonds together. This is the latest reading with the dark blue here. Not as much as what we were seeing before. And then you can go across the different types of bonds that you have available to you, whether you're seeing inflows or outflows. We had been seeing money coming out of TIPS here. Those are Treasury inflation protected securities. It's still coming out of those because the market isn't as concerned about inflation right now. And I have different charts that I go through. I show them in the daily video when they're really telling us something. Mainly, I've been just showing them in the weekly videos because we're trying to figure out the changes as the overall economic climate seems to be shifting. I did find this chart. This is just what do the commodity trading advisors, what do they anticipate doing? And I don't know how they actually figure this out, but looking out 1 week and 1 month, they plan on selling no matter what happens with stocks here. So that could end up being somewhat negative. But we've seen this before, and the S&P goes to hit all-time highs. Well, yeah, here we go. All right, here is the intraday chart where we did have a gap higher open, and that pretty much set the high right at the open, and then we just drifted sideways. We started to drift lower here. We never got quite down to the daily pivot. We were able to stay above that, but then we saw some selling going into the close that took us right down to the daily pivot. So you could say we closed at the low for the day. That's based on price here, and we opened right at the high. That could be taken as a little bit negative, but the fact that we went sideways here just doesn't show an awful lot of conviction right now. Here's our intraday chart. Not much of a change in the initial overnight session here with the futures. We did see this is about the time when Europe started to open up. That's when we saw the futures really improve before the market opened, and then pretty much just drifting down since then. So yeah, it looks a little more negative, but we ended up having a positive day. This is still encouraging, though. We have the blue line above the red line, where growth on an intraday basis is outperforming value. A little bit of a drop off here when we look at the S&P growth to value ratio. We had been a little bit encouraged as we were seeing this ratio going up. In Monday's session, it did drift lower. End of day, growth was up, but up quite a bit less than value. And value was up less for the mid caps and up less for the small caps as well. So that really hasn't improved our overall growth to value ratios here with the small caps. Still not looking all that strong. Mid cap growth to value also not looking all that strong. Coming down a little bit, but looking stronger here when we look at S&P growth to value. We're still in an uptrend with this overall ratio. It was still coming up out of the rainbow, even though it pulled back here when we compare the growth ETF to the value ETF. And holding up pretty well with discretionary to staples. This is encouraging, and we're seeing discretionary doing better. Tesla with their earnings report really helped things out that way. And we did see a bit of a move up here with discretionary, a bit of a decline here with staples. That's what's helping the ratio to go higher. Large cap growth still doing well. Didn't close at its highs by any means, but it's still up and above all the moving averages. Our trend is still weakening since we're below the moving average. That is declining, but we're still above 20. So we are trending. We saw the green line coming down a little bit, but the red line also declined. And we still default to positive here because the green line is on top. Short term, also below its moving average, green line on top, but declining slightly. But we're still in a trend in the short and intermediate term. We're still below average with volume. Here's the weekly sentiment chart that we look at. We really came down. We'd been up in this dark red area. We dropped down to 70.18 now. And looking at insider transactions, this was getting a little bit nerve-wracking here. At least this particular indicator was turning a little bit more bearish. Now it's actually dropped down and is going somewhat bullish. So when that chart is available, I also show this. This is the insider buying ETF. These are legal insider transactions. Not really breaking out or doing all that well as far as when you compare it to the rest of the market in 2024. The VIX did climb back down below 20, so we're just slightly, but we're just kind of right on the fence right now with both with the line chart and the bar chart. Saw a little bit of a decrease here with the VIX of the VIX, both with the bar chart and the line chart. And we had been declining here, and the MACD was picking that up as the VIX was going lower. We've been chopping sideways and drifting a little bit higher. We could be getting ready to see the MACD cross back above its moving average. That would turn the momentum back positive, which would be usually that means it's more negative for stocks. This is an updated seasonality chart of the VIX, kind of showing how we deviated away from historical norms here. We'll just have to see how things play out going forward. And we declined a little bit with this fear gauge. We also declined with this other fear gauge. So some confirmation there. I show this in the weekly video, but this is another look at that same chart. This is the American Association of Individual Investors. It's the bear bull spread where they're coming down. They're not as positive as they were before. We're not getting any kind of an extreme reading right now. But I also plot a 50 period moving average on the chart that I show, and we're still going up with that. And volatility risk premium going back up a little bit, still anticipating risk 30 days off into the future. And so the market is still kind of on edge, but we're not getting any of our other VIX signals that are flashing right now. We went back up with the equity put call ratio daily chart. We're going back up after getting extreme here with the 5-day chart. We're also turning back up with the 10-day chart, and that tends to be more negative for stocks. But when we really pay attention to these charts is when they're really moving in one direction or the other. There's been a lot of choppiness in these charts lately. Advanced decline line turned back up, still above an advancing moving average after seeing some recent weakness here. Looking a little bit more solid. We're closer to this previous high when we look at this based on volume. So internally, this is still holding up. Also, a real drop off in the new highs, no real expansion of the new lows, just drifting a little bit here with our 5-day. We're also going down with our 10-day moving average. And after slightly dropping below zero with the 19-day advanced decline ratio, we're now slightly above zero. It turned back a little bit positive. And we're coming down to the moving average here with accumulation distribution. Not really picking that up with the boom indicator, but you can see how we're drifting lower. So this is showing some continued concern. It was looking like it was improving, but even after Friday's session, we're not really seeing a lot of follow-through strength here. Chicken money flow also dropping off. The histogram is going down and the red line is going down. So this is still positive since it's green, but the context is that we're declining here, and that could be a concern. And the the Chaikin oscillator is really declining. It's barely positive, but it has been declining. So our smart money indicators are picking up some weakness, although they're still hanging on to being positive for right now. The vortex was flat to slightly declining with the green line, and we did go up with the red line, but we're still seeing the green line above the red line, so we are positive. We look at the cumulative advanced decline line here for the S&P based on price, tick back up just a little bit. We also tick back up a little bit based on volume. No real big change there. With the cumulative advanced decline line on the NYSE, we are breaking out and setting a new all-time high, but really didn't see much of a change here with our regular NYSE advanced decline line. This other advanced decline line, I mean, this is still holding up since we're above advancing moving averages here, but it didn't really move up all that much. The common stock on the NYSE turning back up based on price and volume, not really showing that big of a change. Seeing a little bit of an improvement here with the advanced decline line, turning back up with the NYSE common stock above an advancing moving average, turning back up slightly with the S&P, the mid caps, and the small caps were able to get back above their moving average. We look at the S&P 500 and then compare it to the NYSE advanced decline line. It did go up, not really seeing much of a disconnect right now. That's what we're looking for here. And we're showing an improvement with those stocks in the S&P above their 20-day moving averages, but we're still below 50. So that's where I count it as negative, but improving. We ticked back up. We're still positive with those stocks above their 50-day moving average and still positive and ticking up slightly with those stocks above their 100-day moving average and 200-day moving averages. Not really much to see right here as far as the daily chart. We're just kind of chopping around sideways, not really moving all that much, but we're really dropping off when we look down at volume. Turn back up a little bit with our 20, 50, and 200 period moving average studies of the S&P. After being extreme negative, we ticked up just a little bit to get out of that range with the Stochk RSI. We're still above the midpoint with the Williams percent R, and coming back across the midpoint with the CCI 14 and turning back up with the CCI 20. So not really any extreme readings, just because we've not really been moving all that much lately. So even our short-term indicators are not getting extreme positive or negative. And if they are, they're wearing that off pretty quickly. We're even not extreme here. The Stochc RSI still above 50, but kind of chopping around here in the short term with the short-term stochastic. Intermediate term also above the midpoint, flattening out, and we're no longer extreme with the long-term stochastic here. We don't see that very often. Usually one of these charts is extreme, positive, or negative. Barely back to positive here with the force index. You can see a little bit of green there. The condition of the 20-period moving average, we're still below both the lines. The lines are coming down, so we're a little bit concerned about that. We want to get back above these lines and have the lines going back up if we're more positive. If we continue to go down, of course, these lines will continue to decline as well. But we're still above the simple and exponential 20-period moving averages. This has been providing short-term support that got tested a couple of times last week, and we're still holding out above that. We're still slightly above the midpoint with the Keltner bands here. We're not looking extreme, but slightly positive that way. We declined, but we're still above zero with the balance of power and the condition of the 50-period moving average, kind of hanging out around this blue line, which is a double exponential moving average. With the red line above the blue line, the red line moves faster. So this still shows that the momentum for the intermediate term trend is positive. But the fact that we're hanging out below these lines, and if we don't get back above them, that could end up doing some damage. But we're still far away from the 50-period moving averages, the simple and exponential versions. I haven't even been showing those in the video. We're looking a little more positive here with the go, no-go system. They redrew this, and a couple of the bars have turned back to the light, or excuse me, the darker blue. We're still above the midpoint with the highest high value chart here. We're still declining, though. We have all along here with the TTM squeeze. Even when the S&P was going up, the TTM squeeze was still going down. Now, you could say that's a negative divergence if this is an indicator that you really rely on. We're still above zero with the ease of movement, and we're flat but still positive with the Arun indicator. And after being extreme negative with the McClellan oscillator for the S&P, we did show an improvement, but we're still below zero. So we continue to be negative there. So when that's negative, the summation index based on price is declining, and we're also declining based on volume. This is a primary indicator that is one of the warning signs that I've been talking about, showing signs of weakness. We did see an improvement here with the NYSE McClellan oscillator, but again, we're still below zero. So the summation index based on price and volume for the NYSE continued to decline. Saw a little bit of a tick up here with the Swenlin trading oscillator based on price and volume, but both are still below zero. Momentum, as measured by the PMO, crossing below its moving average, we're still declining based on price and volume. Saw a little bit of a tick up here with the PMOs that are rising after we just barely became extreme negative here. We're slowing down, but still declining with the buy signals. We're also flattening out, but still declining with the PMOs in the S&P that are above zero. We're flat with the slope oscillator, and this is a short-term oscillator, tends to be our touchiest oscillator. Well, it's not really moving all that much right now, but the MACD continues to be more negative. So here's the slope going sideways, a little bit more negative with the TSI, which is another short-term oscillator. Then I have three intermediate-term oscillators, the MACD, the PMO, and the PPO. They continue to be negative, looking a little bit more negative, dropping below the moving average with the TRIX, where we're right on top of a declining moving average with the KST. And the TRIX and KST are long-term oscillators. We're looking more negative here with the Copic curve. That's another momentum oscillator that had turned positive, but it didn't last for very long, and now it's turning back negative. The Sean trend meter just into this green area right now. It did decline, but I won't take it off the list until we drop down into this lighter green area. The money flow is still above 50, so that's holding up for right now. And we're ticking up above 50 with the ultimate oscillator. Still above an advancing moving average with unbalanced volume. Still above 50 with the RSI 14 and 9. And we've gone from negative to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR, another primary indicator. And we're still above all the moving averages here, and the lines themselves continue to go up. But we're declining with the bullish percent index. We're just barely above 70. If we drop below 70, that will actually trigger a sell signal, but we don't actually turn negative unless we drop below 50. But the context of this is that it's going down. We're also declining with the NYSE bullish percent index. We saw a little bit of a tick up, and we're above 50 with the NASDAQ 100 bullish percent index. And we're still hanging out above these various moving averages based on 20 periods here. These levels have been also providing some support. And we're turning back a little bit more positive with the hike in ASHI, where the KEGI chart is red, so it's negative, but it's pointing up. And the Renko chart is still positive, and the three-line break chart is still positive. So the trend is still kind of loose a little bit, but still looking positive. Long term, ticking back up slightly with the 150 and 200. We're above these red lines here. That's why I have it being extreme positive. But we've been above this line for pretty much all of 2024. That's showing good longer term momentum. Positive across the board with the Keller market model on all time frames with all the different indexes. Here, we are positive with bonds in the long term based on price, but negative in the short and intermediate term. Commodities are negative in the short and long term, where the dollar is in an uptrend in the short and intermediate term. And that could be pressuring stocks. And we only had two sectors that were down. Tech, which is a growth area, but that was not down very much, 0.03%. Energy, which has been under a lot of pressure lately. All the other sectors ended up being positive, with the financials and materials leading the way higher. And saw some red here, a BPI crossed below 70, but then it was able to get back above 70. That was right after the open. And then the discretionary set a 2-year high. That's encouraging if you're positive. The NASDAQ got above 18.6. Then we had healthcare. Now, this is more defensive. It crossed below 50. So that's not seeing the strength that we were seeing before. And we also saw BPI cross below 50 with the staples. That's also another defensive area. And this is what we want to see if we're going to get back into more of a growth phase and really see the indexes move higher. The Dow, really not much of a change here. It was up 0.65% after setting an all-time high. If it really starts to go back up, we'll be watching this pivot point right here. Just cannot seem to get through that. And a lot of this downward move had to do more with earnings reports that they may have been really good reports, but they saw selling after the report was released. And the diamonds continue to be negative. When we look at the Elder's Impulse system, the NASDAQ, not really breaking out to a new high yet. It was up 0.25%, still holding up, but not really showing a lot of strength right now. The same thing is true with the NASDAQ 100. It was unchanged on the day and not really taking that leadership role the way it was earlier in the year. But we still are positive when we look at the QQQs with the Elder's Impulse system. However, the momentum for the NASDAQ 100 is negative as measured by the PPO. Small caps had a pretty good day, up 1.5%. They were able to get back above their 50-day moving average. And when we look at the Russell 2000 small caps, we crossed back above 50 with the RSI, still above the 50-day moving average with the Russell. But the momentum is improving, but still negative with the Russell 2000 small caps. We've gone from negative to positive with the small caps when looking at the Elder's Impulse system, and just kind of chopping around in the range the last few days with the mid caps. But they've gone from negative to positive with the Elder's Impulse system. The Wilshire still holding up quite well above its 50-day moving average and still in a longer-term uptrend. And saw a little bit of an improvement here with the total U.S. stock ETF in a solid uptrend above its 50-day moving average. Kind of chopping around right now with the staples to tech ratio. The fact that this is declining is more positive, but the fact that we just generated a recent golden cross, that could be negative, meaning that staples are outperforming tech. In a more positive environment, we want this ratio to go down and have tech outperforming staples. Financial sector rebounded a little bit after seeing some profit taking, but still looking really solid. The FANG index was unchanged on the day, but still looking in an uptrend here. Apple was up 0.86% above its 50-day moving average. Microsoft down a little bit, but still above its moving averages here. And we still have yet to see a death cross here. The 50 is still slightly above the 200-day moving average. Amazon was up 0.3%. They're going to be reporting earnings later in the week. Google still up above its 50-day moving average. Meta, which also will be reporting earnings, was up 0.86%. Nvidia was down almost 0.75%, but still looking pretty solid. Tesla was down 2.5% after it really started to jump up. We saw some profit taking there. Netflix was down 0.75%, still looking pretty solid that way also. And we're seeing a bit of an improvement when we look at US stocks versus world stocks. In the short term, the 10-day correlation is going up, but the longer term correlation based on 50 periods continues to go down. Oil really dropped down here. We were in the 70 range before. Now we're dropping down to 67. And the dollar still continues to look pretty solid here, even though it's still in a downtrend as measured by the moving averages. We're going up with the 10-year yield, and this is what's causing some concern for the market here. And we're going down with the 10-year based on price. And seeing things holding up okay here with our growth to value ratios. The Qs to S&P still above the moving average. Discretionary to S&P flat, but above the moving average. Turned down a little bit, but still above the moving average when we compare large cap growth to large cap value. So the large caps, mid caps, and small caps, we're just about back down to the moving average with the small caps, but looking better with the large caps and mid caps. Overall, this ratio has been declining. We want to see this going up when we look at a ratio between the S&P and utilities. That would be more positive, and we're just not seeing that. This is more positive. The Staples to S&P ratio, when that's going down, that's more positive for the S&P. So what's our outlook for Tuesday? We are still positive, and we're above the 20-period moving averages. So that's kind of where we're at right now, but we see some of our indicators, especially in the intermediate term, they are showing some weakness. You can't deny that. It's just what's going to happen. Are we going to break to the downside and see the weakness develop even further, or are we going to go up out of this and be able to get rid of that weakness that we're seeing? We're going to get earnings this week. On Tuesday, we'll get Google. That'll be after the close. Meta and Microsoft on Wednesday. Apple and Amazon on Thursday. So it's a pretty big week, and people are going to be really anticipating that. And then on Friday, we got the big employment situation report. Well, in Tuesday's session, we're going to get the FHFA Housing Price Index, the Case-Shiller Home Price Index, and consumer confidence. We're also going to get the JOLTS job opening. So we'll be getting a little bit of a read there with what's happening that with the employment situation. And then the geopolitical things. And I did add the election here to this particular list. We'll just have to see how that goes, if there's going to be any crazy events on or around the election or even after the election. Here is the economic calendar. Pretty big list here. We already went through what's happening on Tuesday. We're going to get GDP, the first reading for the third quarter. So that could be pretty significant on Wednesday. Thursday is going to be a big day with the jobless claims. We're going to get core PCE that day, the other major inflation component, and the employment cost index is coming out. And then Friday, we're going to get the employment situation report, the final reading for global manufacturing, and then the ISM manufacturing is coming out. That's another major report as well. So the market's going to have a lot to digest. This week that we just finished, we had reports, but they weren't really the influential kind. This week, we're getting the real influential kind. So looking at consumer confidence and JOLT jobs openings, those will be the real focus in Tuesday's session. And then here's the rest of the week. Seasonality, we're all across the board here. We're neutral to negative with the Dow. We're flat out negative with the S&P, and we're neutral to positive with the NASDAQ. And we're coming into the 21st trading day of the month, where we do see a little bit of weakness here during an election year. That's the green dashed line. We also see that when it's not an election year. That's the solid green line that we see up above. But we do see some positive seasonality after the 29th, going into the 30th and 31st here, at least during an election year. These lines are going back up. Tuesday is a flip of the coin based on what happened in 2023, and it's the least positive day so far based on what's happened in 2024. And we're seeing this coming down a little bit with the companies that have blackouts because they're reporting their earnings, so they can't come in and buy their stock or even announce that they're going to be making any stock repurchases here. So that's becoming less of an issue. And if things still remain positive as these companies wear off being in their blackout period, they could come back in and start buying, and that could help things for the market. Here is a new chart. We're coming in when we start November to the best 6 month period historically from November through April. And we're up usually about 7.1% here, and we're up 77% of the time. So this is the better performing year. But that's not automatic. I mean, if it was automatic, this number would be 100% over here. So there are times when we do see some weakness. So what are the warning signs? We do have this confirmed Hindenburg-Ullman, but I'm just not really talking about that right now because there's been no changes to that chart. We're keeping an eye on these defensive sectors, specifically staples, utilities, and healthcare. And so far, growth has been holding up okay, but not really breaking out to the upside. The 5 and 10-day equity put call ratio charts are going up, and we're still negative with the 20-period moving average study of those stocks in the S&P. The Swenlin trading oscillator, it ticked up, but it's still negative. And both the S&P and NYSE McClellan oscillators and summation indexes are negative. Our oscillators and the Copic curve are turning back and looking more negative now. We're keeping an eye on growth to value. Now, this could be on the positive side when you apply it to the S&P because we're still holding up there. But when you look at mid cap and small cap growth to value ratios, they're still in downtrends. We like how discretionary to staples is outperforming. Can that still continue? And then the momentum for the NASDAQ 100 is negative. Positive side, accumulation distribution, the chicken money flow, and the chicken oscillator. These are our three smart money indicators. They're positive, but coming down a little bit here with all three of these charts. And if we see more weakness, we could turn negative with some of these charts. The advanced decline line showed some improvement in Monday's session, and we're coming down with the bullish percent indexes with the S&P and NYSE. And we're after getting an extreme reading both with the S&P and NYSE indicators. We ticked up just a little bit with the NASDAQ 100, but we want to keep an eye on this S&P bullish percent index. The parabolic SAR is still positive. The vortex is positive. Money flow, ease of movement, and ultimate oscillator. Those are all still positive. And the financial sector is positive as well. So what's our conclusion? We're still positive right now. We don't really have an extreme positive or negative type of an environment, but we do see this weakness that's developing specifically in the intermediate term. And in the short term, we're still positive because we're holding above those 20-period moving averages. In the intermediate term, that's where we're watching to see if the Hindenburg-Ullman is going to turn into anything. And this is where we see some weakness developing, but we are still positive in the long term. Thank you. I hope you found this helpful. I really hope you have a great day, and I will talk to you in the next video.